What if I told you that right now your savings account is making your bank significantly more money than it is making you? And the worst part? Most people have absolutely no idea it is happening. Stay with me, because by the end of this video, you will never look at your bank account the same way again. Let me introduce you to two people. Sarah saves diligently. She has $20,000 sitting in a traditional savings account at a major national bank, earning the average rate of around 0.38% APY. That works out to roughly $76 a year. Meanwhile, her bank takes that same $20,000 and puts it to work earning significantly more. Sarah gets $76. Her bank pockets the rest. She has no idea this is happening, and she actually feels good about saving. But here is where things get even more interesting. While Sarah represents millions of everyday savers who are unknowingly getting the short end of the stick, her friend Marcus thinks he has completely cracked the code. He moved his money into a high-yield savings account advertising 4.5% interest. He is earning nearly 10 times what Sarah earns on the same balance. He feels like he won the game. But Marcus has a few problems he has never thought to investigate, and when you see what those problems actually are, it completely changes the picture. But first, let us talk about exactly what your bank is doing with your money behind the scenes. The moment you deposit money into any savings account, your bank immediately puts that money to work for themselves. This is their core business model, and it has existed for centuries. They borrow your money cheaply, then lend it out or invest it at dramatically higher rates. The difference between what they pay you and what they earn is called the net interest margin. And right now, that margin for American banks sits at historically elevated levels. Think about credit cards charging around 21% interest, auto loans running around 7.5%, personal loans closer to 12%. Your bank is funding those products using your deposits. You get $76. They generate hundreds or even thousands from that exact same money. But there is one specific move your bank makes with your deposits that should genuinely make you stop and think. Your bank takes a portion of your deposits and buys short-term US Treasury bills, currently yielding around 3.6%. They earn that 3.6%, turn around, and hand you 0.38%. Here is the critical insight that changes everything. You could buy those exact same Treasury bills yourself and keep the entire yield without anyone taking a cut. The bank is simply acting as a very expensive middleman between you and the US government. Now, back to Marcus, and why his high-yield account, despite being far better than Sarah's option, still has some hidden problems worth understanding. Marcus sees 4.5% and feels satisfied. But that advertised rate can disappear overnight without any real warning. Banks regularly use promotional rates to attract deposits, then quietly lower them after 90 days. Beyond that, every single dollar Marcus earns in interest gets taxed as ordinary income at both the federal and state level. If Marcus is in the 22% federal bracket with an additional 5% state income tax, he loses over a quarter of his interest earnings to taxes immediately. His $900 becomes closer to $650 in his actual pocket. And here is the final layer that most people never discover. A Treasury bill ETF like SGOV currently yields roughly 3.55% to 3.95%. That appears slightly lower than Marcus's advertised rate, but here is the twist that completely changes the math. Interest from US Treasury securities is exempt from state and local income taxes by federal law. So Marcus pays both federal and state taxes on every dollar his high-yield account earns. The Treasury ETF investor pays only federal tax. In high-tax states like California or New York, that exemption alone can close the gap entirely and even tip the scales in favor of the Treasury option. But beyond the numbers, there is an even bigger reason this matters. Marcus's high-yield rate is controlled entirely by his bank. It can change at any moment based on whatever business decision they make next quarter. The Treasury ETF tracks actual government auction rates set by market forces. There is no promotional bait and switch, no fine print rate tiers, no sudden email announcing a lower rate. You are lending directly to the US government and keeping the yield. No middleman taking a cut. So what should you actually do with this information right now? The practical steps are straightforward. Keep your checking account exactly as it is. You need it for daily spending and bills. The goal is to relocate your idle money, your emergency fund, your savings, sitting and waiting, the cash earmarked for a future purchase. Move that money to either a Treasury ETF purchased through any brokerage account you already have, or directly through treasurydirect.gov, where you can buy government bills with zero fees or intermediaries, or a Treasury-focused money market fund through brokerages like Fidelity, Schwab or Vanguard. The objection I hear most often is about FDIC insurance. And yes, FDIC coverage is real and valuable up to $250,000 per depositor. But consider what you are actually comparing. FDIC insurance is a government-backed guarantee on your bank. Treasury bills are direct obligations of that same government. You are not trading safety for yield. You are cutting out the bank that was standing between you and that government yield the entire time. Sarah followed every rule she was ever taught and still lost hundreds of dollars she never knew she was missing. Marcus did his research, made the switch, and still stopped one step short of the full picture. The real question was never which savings account pays the most. The real question is why you are letting anyone act as a middleman between your money and the safest investment on earth. If this opened your eyes to something happening in your own account right now, hit subscribe and the notification bell, because we cover exactly this kind of hidden financial math every single week.